Welcome back. You're still tuned into Trading Hour. It's time to talk about market fundamentals now. Manish Jain from Centrum is joining us now to discuss the same. Manish, good morning. Thank you so much for joining in. Well, you talk about certain factors that would lead to earnings growth in Q1 and the next fiscal as well. Can you outline them for us? What's working for the markets right now?
Yeah, so this year has been a little bit of an aberration if you look at the post-COVID world since 2020, 2021. We've kind of consistently delivered double-digit returns year after year, every single year, except for FY25, right? So after a very long time, 2010s essentially was an era of miss where we were expecting 15%, 17% kind of earnings growth from Nifty, delivering 5-6%. But this has been a different era. FY25 was the first year where we saw a massive downgrade, successive through the quarters, Q2, Q3, Q4, right? Every single quarter when earnings came out, the street downgraded the estimates. But I think we are now at a juncture where it is expected to bounce back. I'll be very surprised if Nifty fails to deliver somewhere close to 12, maybe 13% sort of earnings growth for FY26 and a very similar sort of a number for FY27. I think some of the factors that are going to contribute into this kind of a turnaround in earnings growth, number one is RBI. They have been very supportive, both injecting liquidity into the banking system, plus overall 100 basis points sort of a rate cut. Again, would be very, very surprised if we don't see at least another 25 to 50 basis points kind of a rate cut in the remaining part of this current calendar year, given that inflation footprint continues to remain at a multi-year low. The monsoons have been progressing fairly decently well. I think from a banking sector perspective, most of the NPA and asset quality related issues are now starting to bottom out. So maybe another quarter or so before you start seeing a turnaround over there. So the only sector where some sort of earnings concern continues to remain essentially is going to be IT. But except of that, I think by and large, most of the other sectors look set to come back very strongly. Largely driven by top line growth and not margin expansion, as we've seen in the last 2-3 years. Consumption, again, is another factor that should come back. Urban consumption, discretionary consumption. And given the state of the monsoon and the inflation footprint, I think rural consumption as well. So I think a mix of everything, plus the government's fiscal policy and the budget, I think has been very, very supportive. So you will see a transition from an investment-led economy into more of a consumption-led economy, and that should progress out into the next couple of years.
Manish, good morning. Thank you for joining in. This subject of consumption picking up has been a topic of debate for a while now, and there have been opinions on both sides of the spectrum. I was reading a note from HSBC which talks about a $40 billion consumption boom in the country over the next 2 years. You were just speaking to Mukul Kochar last week, and he mentioned that from a consumption-led economy, we are moving towards a savings-led economy, and that is not very good for consumption. So in a scenario like this, you mentioned that you're expecting both rural and urban consumption to pick up for a variety of reasons. So within this basket, where is your preference lie? Within the discretionary space, within the staple space, where are you placing your bets?
No, I think I'll be more inclined towards a discretionary consumption space. I think staples consumption companies are going to continue to face a little bit of a disruption from a medium to long-term perspective, unless they really evolve in a certain way. I think what has happened with staple consumption companies, especially the market leaders, is they've kind of failed to keep up with the changing times, right? The advent of food tech space, especially quick commerce, has kind of disrupted the entire space completely. So I don't know how comfortable I would be paying, 50x multiple, say for a sector where you are expecting low single-digit kind of a sustainable volume growth going into the next few years. I'm structurally a bear in that space. But if you look at the Indian economy and the way we are poised, even in a very, very base case scenario, we should be able to deliver 5 to 6% sort of a GDP growth rate. You add about 3 to 4% sort of inflation on that, you're looking at 9 to 10% sustainable nominal GDP growth rate for a country whose population is continuing to grow at less than 1% pace. So your per capita GDP on an average will continue to rise year after year, every single year for the next 5, 6, 7 years. That's pure mathematics. And that is essentially what the key driver for discretionary consumption is going to be. And that encompasses everything at the right time, at the right place, maybe autos, white goods, brown goods, real estate, and even some of these domestic consumption plays like, for example, hotels, hospitals. I think they're all good for a certain price. And as an ancillary play, you can even look at EMS.
Okay, EMS, that's an interesting space to look at. Manish, there are a lot of sectors which will be in focus on the back of earnings. Which space do you think will not likely do well despite the demand pickup, despite good macros?
I think IT continues to be in a little bit of a limbo. That is going to be something which is going to be very interesting to watch out for. The last quarter was obviously a little bit of a challenge. The uncertainties in and around the US economy and the demand pickup from that frontier, I think, continues to be a little bit of an overhang over there. So IT is going to be one sector to watch out for. And like I said, even though I'm a little bullish on banking from a one-year perspective, Q1 is going to be very interesting to watch out for because credit growth has not yet started picking up, right? Back to 13-14% kind of numbers. And in a scenario of rate cut, you should expect a little bit of a NIM compression over there as well. And then particularly from an MFI space perspective, it will be at least one more quarter before the kind of whole asset quality issue settles down and you start seeing a turnaround over there. So that again is going to be a little bit of a mixed bag, something which is going to be worth watching out for. But domestic consumption driven stories, I think, should report fairly strong numbers.
Manish, I'd want to pick your point on the staples bit that you mentioned. You would not want to pay a 50x multiple for staple companies because you believe that they would continue to struggle. But you mentioned EMS as one of your sectoral preferences. But even those names are trading at around an 80x or 100x multiples for the likes of Dixon or for the likes of Amber, PG, Electroplast. Is this the growth runway that they have is what is justifying your conviction on these names despite the elevated valuations that they trade at?
So it's sort of 2010s, which is playing out for the EMS space today, as it did for the FMCG companies, back then. Multiples we saw from 20 to 24 times got re-rated to as much as 70, 75 times in those 7-8 years, when nothing else worked in the Indian markets except for FMCG companies. The point basically being that people are okay paying any multiple as long as the growth holds up. When you start seeing structural growth concerns is when the multiples kind of collapse across the board. We've seen that in retailing, we've seen that in FMCG, we've seen that at certain points of time in defense in the 3 years back. So we've seen that across the board. And that's essentially the key concern. But EMS, if you see, like I said, if you're looking at a $7, $8, $10 trillion kind of an economy by mid-2030s, and you're looking at the per capita GDP going from $2,700, $2,800 to say $5,000, then discretionary consumption, lifestyle plays is going to continue to play out over here. And if that is going to be the case, then these companies, which are right now growing at a certain pace, they have kind of just explored the tip of the iceberg as far as the entire spectrum of growth is concerned, unlike the FMCG companies. So as long as the growth runway holds up, I'm optimistic.
All right, Manish, pleasure having you as always. Thank you so much for spending time and joining us today. That's Manish Jain of Centrum. As we take a short break, here's some good news for our viewers. India's business news leader is now just a click away, and that is, of course, CNBC-TV18's all-new app. And it gives you breaking news, financial world updates, and in-depth articles, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. We take a short break, back on the other side.